We're preparing and we are live. Kenny, how you doing today?
I'm really, really good, and I'm really, really stuttering. Holy cow, that was a rough start.
Well, we just had 7 conversations going on at once about 30 seconds ago. So
Yep, a couple of coffees, a couple of Diet Cokes. I'm shaking. I got the right amount of caffeine. Go time.
yes. All right. ARMs, adjustable rate mortgages.
Flashback to 2002 through 2004.
Oh my gosh.
Remember that?
Yeah. We were doing 6-month ARMs back in the day.
That was a few years before, but yeah, we were talking to the crew about that the other day, and you had 1, 3, 5, 7, 10-year ARMs, 6-month ARMs, different caps, prepayment penalties, no prepayment penalties. It was like you had to take a class to understand them.
My first house I bought in 96, I had a 6-month ARM at, I think it was 6.875.
But at least it was fixed for 6 months.
It was fixed for a whole 6 months.
Yeah.
And I think that we redid that maybe 6 or 12 months later. I can't even remember. Funny.
Well, you know, a friend of mine that became a friend of yours, but we did a 5-year ARM for him in 2003, and he had that loan all the way until 2020. So he went through 9 adjustments after that fixed period and never paid more than 4.25%. So
It's crazy.
yeah, it's that. I love this conversation because it's a total flashback to, gosh, I think it feels like with 60, maybe 65% of the loans we did for a period of time were on adjustable rate loans. And
I did my first fixed rate mortgage 2 years ago. So it took me, I don't know, 20 something years, 96 to 18, 22.
yeah, my first one
So I
was
did
2019.
Okay, so what we're seeing now is it's flipped in the last 30 to 45 days where adjustable rate mortgages are back in play. The rates are lower than 30-year fixed money and 15-year fixed money for that matter. And we have all these people that are concerned about getting approved for the mortgage now that rates are on the rise. Talk to me about that's the biggest pro we have right now is probably mentally up here. It allows some folks to not get too overly amped up about rates moving up.
I personally think that the increase in interest rates isn't that big of a deal on the qualifications for most people out there. So you're correct. This adjustable rate thing is a big deal for the marketplace so that we can avoid some emotional shock and allow people to stay rational and keep on that process of whatever it is that they wanted to do.
It's that easy, folks. It's that easy. Stay rational. You're good.
In a couple of the conversations I have in this, it's like, all right, we've got a way to sort of offset the interest rate risk. And some people have said, I'm all in. That totally makes sense. Some people have said adjustable rate makes me nervous. So that increase that's taken place, it's not that big of a deal for us. So this conversation or the option, it can help us on both sides.
Okay, so let's provide some basic context right now. Let folks know 30-year money, 5-year money or 10-year money.
Okay, 30-year money, assume 4%.
Okay.
5-year money is going to be 3, and 10-year money is 3.25.
Okay. So most folks haven't even looked at this in 3 years, right? What
longer than
is it?
that.
Longer? 5?
Yeah. So if I look at the adjustable rate loans as a company, with one exception, the only adjustable rate loan we did was when you moved to Florida in 2007, late 17. That was the last adjustable rate loan.
Wow.
So it's been almost 5 years since this has been an option to consider.
Okay. That's exciting. I mean,
It really
exciting
is.
for folks
Yeah.
to, hey, you have a couple of different things to look at, a couple different things to think about. What's the first con that you think of?
Understanding.
Gotcha.
The second con is if you go back to the housing bust or bubble, we go 07 to 09, when there was just chaos in the marketplace. Much of that chaos was associated to adjustable rate mortgages, but those adjustable rate loan mortgages are different than the ones that we're talking about now. So there's a stigma, and there's been no value add proposition since 2009 or 10 until right now. So that's part of it. Since 2009 or 10, adjustable rate loans just have not provided any value to be considered until the last 3 weeks. So now
It's crazy.
you can get an interest rate that's guaranteed for 10 years and pay 0.75% less than your fixed rate alternative. Now, if you're borrowing $300,000 to $400,000, that savings is worth considering some risk. Good God, 10 years from now.
So the average first mortgage stays on the books for just under 7 years. So that 10-year option that you're describing is really not a big deal in most folks' mind.
I wouldn't think so.
Okay. So now we get to the 5-year where it gets a little.
Now we're rolling. That makes me feel a little uneasy.
Okay.
Some people have said.
It's just funny when you think about where we were in 08 to 12. Values complete dumpster, never seen anything lower. Now we're in 21, 22, never been higher.
That pendulum swing, right? We saw the worst, and now we see the best.
Opposite of where we were. We were talking about this the other day.
For sure.
So what does that mean in 5 years if somebody starts to adjust? Well, first off, explain, if you take a 5-year or a 10-year, what does that mean to them right now? Is there prepayment penalties on these loans?
Okay, so this is the question that you're spot on. What is an adjustable rate loan? So this loan commitment that you agree to make is a 30-year loan. So there's nothing that can take your ability or speed up that unless you fall into default. So you have a 30-year loan. It's
amortization.
Just 30-year. Yes, you have a 30-year amortization. So it's going to be paid off in 30 years if you don't do anything with it, and you will have 30 years to pay it off. So the 5-year part means that your interest rate's fixed for 5 years. At the end of that loan now turns into an adjustable rate loan every 6 months thereafter. There's no prepayment penalty. The loan re-amortizes on every adjustment. So what that means is if you started at 300,000 and you've been paying big chunks toward it, and at the end of 5 years, your balance is 200,000, they're going to recalculate the payments for the next 25 years based on that balance. So you could see a substantial payment drop. And then there's an economic index that is used to determine the rate plus a margin. So that index now is the SOFR index, and that's currently hovering around 0.5%. So that's the economic index is at 0.5. The margin is 3. So if that loan were to adjust today, you cram those two together, round it up to the nearest eighth of a percent, that interest rate would be 3.5%. And that process happens over and over and over.
So what we're doing for these folks that are getting into these mortgages is obviously reviews all of the time. So we're letting them know every 6-12 months where they're at, what it's going to do, what it would be if you redid it right now. You can move back, you can refinance to another arm, you can refinance to a fixed at any time. There's no penalty, correct?
Correct.
Okay. So 3/4 of a point, you said let's use $400,000 mortgage. I mean, we're talking $3,000 a year in interest, right?
Yeah,
Times 10 years.
that's 30,000 bucks that you're playing with the house's money. So year number 11, if it goes 2% higher than where you started, I just do it in terms of the interest rate. So if you're saving 3/4, you've got 10 years of that savings, that's 7.5% that you've saved in 10 years. It can go up to year number 11. So if we take 2 away from the 7.5%, you're still playing with the house's money of 5.5%. If you haven't moved or refinanced at the end of 11 years. And then you can do that same math to say, all right, let's just keep assuming the worst case scenario. It pushes your loss, meaning that you've still won, out to about 13 years before you have any chance of losing based on how the interest rate has worked over that period of time.
So everybody that's a homeowner watching this, you need to ask yourself, have you redone a mortgage in the last 13 years? Every one of you have. Very, very few exceptions. Maybe somebody that went to a 15-year fixed 15 years ago and they're at the end of it.
The other thing that we were talking about with the team the other day is 2012, we saw the lowest rates in mortgage history. 2021, we saw the lowest rates in mortgage history. So that's a 9-year window where we've seen 2 opportunities where rates got to the lowest points ever. As some context, can we catch lightning in a bottle in the next 9 or 10 years? Probably.
Well, we have so many folks right now who are taking advantage of the equity position in the home based on the run up, where they got into a fixed rate product at 3.25, and they're redoing their mortgage to debt consolidate. They never knew they were going to gain $100,000 in equity in 2 years. How could you ever know that? So all of these are stuff happens. I was going to say something else, but stuff happens.
It's fun when you talk to somebody and it's either their first home or maybe it's the move up home. Oh man, I'm going to be here for a long time. Okay, I agree with that statement. Even though something may change, I believe you that that's your intent. But even if you are in that home, those things that you mentioned are crazy. The things that we see people refinance for that they did not anticipate or did not give forethought to. Again, this situation that we're talking about here, we've done loans for people that have increased their mortgage balance so they can put money into their savings account and increase each month what they're sending to retirement funds or investing. And that is a brilliant idea. You've said this a number of times. You want to balance your portfolio. You don't want to be too heavy in equity and you don't want to be too heavy in the stock market. You want to have some balance. And there's things that people should consider using that equity for.
Well,
again,
it's
moderation.
But it's hard to get there. I'm in this right now in the home I'm in 4.5 years ago when we did that mortgage. Never would I have guessed the explosion of equity. So now my portfolio is very unbalanced because of all this equity gain in the home. I need to use some of that equity, move it to a different spot. So all my eggs aren't in one basket. Could be a hurricane wipes this place out. I don't know. There's always something that can happen though. We're trying to help folks talk that through and at least understand and recognize that if you have a couple $100,000 of equity in your property and you have 10, 20, 40 grand of consumer debt, then you need to do something.
That this whole adjustable rate conversation, the reason why I'm so excited for it is like what we talked about. It helps to not douse enthusiasm about something people could and should be doing. So if it's affected your comfort on a purchase because of the rate increase, well then, hey, a 10-year ARM gets us right back to where we were 2 months ago. Keep moving.
Yep.
For the most part, that holds true. On the refi side, people sitting around and going, I know I need to do this, and they're not comfortable with doing a home equity line of credit. You know what? A 10-year ARM or getting that rate secured for 10 years should not provide any hesitation to still do what you were looking to do.
Sure.
Because the reality is a 10-year ARM is darn near as good as a 30-year fix. Your risk associated with that is so small.
Yeah.
Because of the probability that something else is going to happen to take place.
We haven't talked about it because it hasn't made sense. Now it makes sense. So we're going to talk about it.
I get so excited.
I know. So when we get into these, when you guys are looking at the spreadsheets, give yourself an extra 5 or 10 minutes that we have to get through some of these decisions that you have to make. That's awesome. Awesome information. It's an awesome product. If you're into that and it makes sense for, what your goals are. Guys, thank you. Share this group. Please share the group to any of your friends, family members, coworkers. Don't forget to check us out on YouTube. And that's that for the week.
Is that a wrap?
That's a wrap.
Wrap it up.
Wrap it up.
All right, man. Thanks again. See ya.
Have a good day.